Okay, 290.91%. Let that number just sink in for a second. That is the absolutely jaw-dropping trailing 12-month return for advanced energy industries. Think about that. If you had invested just a year ago, your money would have nearly quadrupled. It's exactly the kind of momentum that immediately grabs the attention of Wall Street. But as focus learners, we always want to know exactly what is driving that number.
So today, we're diving deep into an explainer on advanced energy industries, or AEIS for short. Right now, this stock is basically acting like a top-tier luxury sports car. It's incredibly fast, it's turning heads, and it's breaking records. But our job is to look past that shiny exterior and lift the hood. We really need to figure out if the astronomical sticker price the market is asking for is actually justified by the machinery inside.
Here is our roadmap for today's explainer. We'll start with the price explosion, then we'll dig into the financial fundamentals, run a valuation reality check, and finally, we'll weigh out the risks.
Kicking things off with Section 1, the price explosion. Let's talk about the sheer velocity of this stock, which is currently fueled by a staggering market cap of over $14.6 billion. This isn't some tiny small-cap company flying under the radar. We're looking at a heavyweight that has quite literally been defying gravity.
And it's not just a one-day wonder either. Across multiple time frames, the returns are nothing short of spectacular. We're talking a year-to-date return of over 84%. Over 3 years, it's nearly 358%. Zoom out a full decade, and investors are sitting on a completely massive 1,051% gain. The market has relentlessly rewarded this ticker over the long haul.
But, while the momentum feels completely unstoppable today, history does give us a bit of a reality check. We're seeing massive 80+% gains in recent years, like 2025 and 2026, but look back just a few years to 2022, and we see a negative 5.36% return. It's a great reminder that even rocket ships experience turbulence.
So with momentum this explosive, we really have to pause and ask ourselves, what's actually powering this engine? Are these triple-digit returns supported by booming profits and hyper-efficient operations? Or is this primarily just a story of market enthusiasm pushing the price higher and higher? Which brings us to Section 2, the financial fundamentals. Time to look at the reality of the business.
Let's step away from the stock ticker and the daily price action for a minute. Looking at the baseline size of the business, the company generates a really solid $1.8 billion in trailing 12-month revenue. This is a real, tangible business moving serious volume. But out of that massive top line, they managed to keep about $148.4 million as pure net income.
Let's break down how that actually plays out. Their gross profit margins are a very healthy 36.77%, meaning they're making good money on their raw products. But look at what happens by the time we reach the bottom line. Over 57% gets swallowed up by operating costs and expenses. That squeezes the final net profit margin all the way down to just 6.04%. So yes, it's a profitable business, but it's operating on relatively thin net margins.
That said, the internal mechanics, they're actually quite solid. Management is delivering a decent 11.89% return on invested capital. Add to that a highly manageable debt-to-equity ratio sitting low at 0.42, plus strong liquidity metrics well above 1. The business is undoubtedly stable and solvent.
Okay, so they have over $1 billion in sales, solid returns on capital, and low debt. The engine runs smoothly. But what's the catch? Well, this brings us to the crux of our explainer, where that luxury sports car metaphor hits a major unavoidable speed bump.
Welcome to Section 3, the Valuation Reality Check, or as I like to call it, paying for perfection. We know the business works, but we really need to slow down and take a highly cautionary look at the actual price tag here. Let the sheer size of these valuation multiples sink in for a second. A price-to-earnings ratio of over 100, a price-to-sales ratio over 8, price to book near 11, and an enterprise value to EBITDA of almost 57. It's wild. The market is pricing AEIS as if flawless hypergrowth is entirely guaranteed forever.
To find the actual intrinsic value beneath all this hype, we have to look to the discounted cash flow. By stripping away market emotion and focusing purely on the present value of expected future cash flows, we anchor our expectations in mathematical reality, not just momentum.
And here is the crucial point, this stark, glaring contrast. Based on those cash flows, the mathematically calculated fair value price of AEIS is just $75.57. But the current market price, it's trading way up at $385.68. The market is paying roughly 5 times more than what the underlying cash flows say the business is actually worth.
This massive gap brings us to a concept we all know, the margin of safety. It's that critical buffer we need in case growth slows down or the company hits a rough patch. It's the difference between intrinsic value and market price that protects your capital when perfection just isn't achieved.
Well, for AEIS, that margin of safety is a highly alarming negative 410.35%. Yeah, negative. You have absolutely zero buffer here. Instead, you are sitting on top of a massive premium, which means virtually all the risk is on the downside if the company fails to deliver absolute perfection in its upcoming earnings.
Which leads us perfectly into Section 4, weighing the risks. It's gravity versus momentum. Let's see how all this data builds into an actionable risk profile.
First up, we have to look at yield compression. Because as the stock price has skyrocketed, the actual underlying yields investors receive have absolutely plummeted. The free cash flow yield is sitting at just 0.86%, down over 50% compared to its recent average. The earnings yield is barely over 1%. When you buy at these extreme highs, your real-world yield becomes vanishingly small. And hey, if you are hoping for some passive dividend income to act as a parachute if the stock drops, you're kind of out of luck. A tiny 0.10% dividend yield with 0 consecutive yearly increases offers virtually no downside protection. You are relying entirely on the stock price just continuing to go up.
So, to summarize, we are looking at a pretty fascinating standoff. The bulls see a fundamentally solid business with a decent return on invested capital, riding a life-changing 290% market run. But the bears? They are waving some huge red flags. A PE ratio stretching past 100, an intrinsic fair value anchored way down at $75 compared to a $385 market price, and a deeply concerning negative margin of safety.
It's a lot to process, so I'll leave you with this final thought to ponder regarding the rationality of the market. Is a blistering 290% momentum run worth completely ignoring a $75 intrinsic fair value? Does the market know something the math doesn't, or is gravity about to kick in? Thank you so much for joining this explainer and keep asking the right questions.